gets a piece. We're going mainstream. Everybody's gonna eat. We're going mainstream. All my family is sing. See you on Main Street. We're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. On today's show, we turn the tables. We welcome famed podcast co-host of Animal Spirits and the Compound and Friends, and managing partner and director of research at 4 billion AUM Ritholtz Wealth Management, Michael Batnick, to come on the show to share a wealth manager's perspectives on private markets. Michael's career has taken a number of fascinating turns. He started selling insurance before a chance meeting on the platform of a subway station with Josh Brown of Ritholtz Wealth after a New York Knicks loss led to a job offer at Ritholtz Wealth Management. At Ritholtz, Michael has been an integral part of the team that has helped drive the firm's growth, leading with content and education. Each of the firm's partners have built impressive content platforms across blogs, books, and podcast channels. Their thoughtful approaches to investing come through in their work, and it's translated into how they think about private markets. Michael provided interesting viewpoints on why alternatives have yet to be adopted by many advisors and the challenges with adopting alternatives products. Michael and I had a fascinating discussion at the intersection of wealth and alts. Michael and I covered his journey into wealth management and the lessons he's learned along the way, the importance of education and networking in the wealth management industry, how he thinks about risks in public and private markets, the evolution of wealth management as a business, why alternatives products are still sold and not bought, the importance of staying focused on fundamentals and long-term investing, and the workflow challenges that alternative investments have for a wealth management firm. Thanks, Michael, for coming on the show to share your thoughts and wisdom on investing.
In a collision of culture and finance.
We're going mainstream.
Michael, the tables have been turned. Welcome to the Alt Goes Mainstream podcast.
Thanks for having me.
You are usually on the other side of the table. All the amazing content and media that you've done as a both just in terms of providing content to the industry and also how it's helped you build a business. But would love to just start with how you got into wealth management.
So I've told this story many times, but I have a feeling that our audiences are non-overlapping. So I'll repeat myself and feel free to interrupt or cut me off or whatever. I was a jackass of a child and I didn't take my education seriously at all. And I mean that. And I have proof. I got kicked out of the same college twice.
You got readmitted though.
That's true. I did do that. So I do think about those times quite a bit. What was going on in my life? How did that happen? Where was I mentally? And I don't know, but whatever. So I didn't take my education seriously. I wasn't somebody who was surrounded by money growing up. For whatever reason, it just never occurred to me. And I know this sounds like beyond idiotic. I always had this weird sort of like inner confidence that everything would be fine. And that's just my personality. It's not like an irrational confidence in myself, although I do have maybe a little bit of that. But externally, I didn't have that. So I couldn't project my inner confidence out into the world. And I always thought everything would be fine. And it turns out, hey, asshole, everything's not going to be fine. You actually need to go to school because you need to network, you need to get internships, you need to get a job. Like none of those things. I don't know if it's because I don't want to blame my parents, but I had wonderful parents. Whatever. It's just I didn't grow up around investment bankers. Okay, I didn't know any of them. I didn't know money like those people. So it only occurred to me when I was fortunate enough to graduate during the GFC, and the only place that would hire me, and hire is even a funny way to phrase it because I was paying them literally. I'm talking about an insurance company, and they'll hire anyone because the business was good for them. You pay them rent. I swear to God, I paid rent. You get no salary. And if you happen to sell a few insurance policies, wonderful. They know that 98% are going to fail out. If you sell 7 policies, they'll go after them, right? So that's what I did. That's how I got into, I'm using air quotes, like the business of financial advice. And I stayed at the insurance company for probably a year and a half. And I was the last of my cohort to stay, not because I was successful, quite the opposite. I was so much of a failure that I couldn't leave. Even though I was paying rent, even though I wasn't getting paid, I had nowhere else to go. And so eventually I left because I spoke to somebody who said, oh, just get a job at a hedge fund. Why would, do the CFA? And I was like, oh, yeah. That's a great idea. Just get a job at a hedge fund. Great idea. Thank you so much for that advice. So I took that advice and I ran with it. I left the insurance company and I started sending out resumes. Again, this is like 2009. So maybe not the best time for a loser with no resume, no network, no nothing to offer to the world to start sending blind resumes out. And you can imagine, I've gone back and looked at some of my emails that I've sent, and it's cringe to the maximum. And so anyway, long story short, I got lucky. I got very, very lucky, like phenomenally lucky. And you hear people say that, people with success, a little bit of success, say that I got lucky, but you kind of know it's just like, it's false humility. I got lucky because, again, I already told you I got kicked out of college twice. I couldn't get a job. I was unemployed for almost 2 years, and I was about to pack it in and just get a job at the mall, like at a retail company. I had no idea what to do with my life. And then I met who was my hero at the time, and this is Josh Brown. And I met him at the train station on a Friday night after the Knicks were getting blown out in game 3 of the 2012 playoffs. And I left early, and I'm a lifelong diehard Knicks fan. I never stopped watching ever, like even during the lean years. So for me to leave, it was the third quarter, right before I sat down, go to the game. As I'm sitting down, I get an email for my last potential job lead, Sorry, kid, we can't help you. And I remember it like it was yesterday. There's like a light bulb moment. Like, now what do I do? Like, I was beyond lost. And I'll never forget Mario Chalmers hit a corner 3 to put us down 21 points or 18 points, whatever it was, with like 2 minutes left to go in the third. I said, I'm leaving. I'm out. My friend's like, where are you going? And if I didn't get that email, I would have stayed. If Mario Chalmers didn't hit that shot, I would have stayed. And it was that night that I left early that I met Josh Brown at the train station. And so there's a lot more to it, a lot of jobs that I almost got but didn't, that led to me getting beyond lucky. So I met my hero, he hired me, and that's how I got my start in the industry.
Wow. That is fascinating story on a number of levels. What do you think you learn most also from working in the insurance world?
Just massive, massive appreciation for what I have today. I was cold calling people, and I am not a natural salesman. I cannot sell something that I didn't believe in. At the insurance company, I sold 0 policies to people that were outside of my family. And so going from cold calling people, so calling strangers to sell them that they didn't want to buy and frankly didn't need to buy and shouldn't have been buying, to getting people reaching out to us because they appreciate the message that we're putting out into the world, is something that I will never take for granted.
That's kind of what you do now, in a sense, is sharing thoughts and expertise with the world. Was that kind of maybe the light bulb moment that made you say, hey, I should create content and share? Because you were one of the earlier people in the industry to do that, and look at what's happened now.
When I started with Josh and Barry, I had all sorts of roles and responsibilities. I was doing trading, I was doing billing, I was doing account aggregation, I was doing all sorts of different things. And then when our fourth partner, Chris, joined us, Chris is a CFP. Chris is a financial advisor, a financial planner. He's actually talking to clients. And sitting next to Chris, I quickly realized that's not what I wanted to do. It's not what I thought I was particularly good at. The empathy, the connecting, that's not who I am. That's not my personality. So I wanted to really carve out an area that I could add value. And it was the investing thing that I fell in love with, even prior to meeting Josh. So I thought that, hey, listen, Josh followed Barry's footsteps. Why not take a chance and see if I can generate an audience fully standing on their shoulders? This would not have happened without them. And so I don't know that I necessarily had any, in fact, I'll say for sure, I don't think I had any delusions of grandeur at the time that I started, that it would turn into what it has turned into, but one step at a time. And I was relentless in my pursuit in terms of just dedicating every spare hour of my life to catching up on 25 years of being a jackass. I was obsessed with reading, spending time in the library, getting caught up. And so that's what my focus was on.
So I want to go back to something you said earlier and tie it into what you just said, which is you had this belief inside that you thought everything was going to be okay. And I think that's really interesting to think about in the context of investing, because you obviously write a lot about investing. And I think some of your writing, particularly more recently, is make sure to be simple, don't panic, don't do too much. That's kind of been the theme. And we've reached a number of all-time highs. I think recently you wrote that there's all-time highs are actually a great time to buy stock. That goes against some of the mental frameworks that people might have, whether founded or unfounded. How do you think that the way in which you were internally has helped you think about markets and investing?
One of the things that I did early in my investing journey that I think really helped a lot was keeping a journal of my trades. I would write down what I was doing and why I was doing it. And the reason why this is so important is because people are very good at lying to themselves or misremembering how they felt at a time. Oh, I knew the market was going to bounce. I knew that stock was going to go up. No, you didn't. And I have proof because I would read my journal 6 months in the past, and it was truly comedy, like an absolute clown show. And I think what I'm very good at is I'm not delusional. I don't overinflate my abilities. So I was able to smell the roses pretty early that this is difficult, that a lot of what people are saying on social media is bullshit in terms of projecting their success. I saw the data, I read the literature. And so that's how I discovered that beating the market, it's tough.
So then what should people do instead?
Well, that is a very, very big question. What should people do? I think what people should do is work backwards. We spend a lot of time talking about the economy and the market, and I love it. It's the greatest game in the world. And oftentimes we lose sight of, well, what are we like literally even doing this for? Why are we putting ourselves through the anxiety and mental stress of having to worry about it? Well, because it serves a purpose. Money actually matters for a reason, and the reason is different to everyone, but ultimately it's security. Can I give my kids, my family, my spouse, whatever, what I want to give them? And so if you can do that and work backwards and say, okay, like just basic, like risk and reward. And that's not universal, that's personal. So I think generally speaking, my belief is that you should take as much risk as you can such that you can survive the upside and the downside. And what I mean by that is if you have 40% of your money in stocks and 60% in cash, and then the market goes up 30%, and then you're like, oh my God, then you do something dumb with the 60% of your cash and you put it all into the market. That is obviously poor behavior. But if you have 90% of your money in the market and you're in a bear market, the market's down 30% and you bail, well, that's bad behavior too. So you have to find a middle ground of what is the allocation that I could stick with in a wide range of environments.
Really interesting point on kind of the psychology of how people should, one, think about markets, but also think about what their goals are. I want to take that question to talk about how today's markets, technology, and younger investors all factor into this. What is your biggest worry for younger investors who now have easy access to investing in markets and access to the dopamine hits and conditioning that occurs from social media? How should they think about what you just said and navigate the market given what I just shared?
Yeah, I'm actually pretty optimistic about this. And here's what I mean. So before I described everybody's personal risk and reward bands, and it's different for everyone, you only know where your lane is or where your line that you shall not cross is by crossing it. That's the only way. None of how you feel about risk and reward or losing 30% of your money, none of that can be simulated or discovered in a book. You only will learn from trial and error. And the reason why I'm optimistic about young people is I understand the thinking behind, oh man, the market is just a giant casino. And to an extent it is. I think that young people are smart, and I don't think it takes that long before they're like, okay, maybe this is probably harder than I thought. But you can't tell that to anybody. Hey, don't try and beat the market. It's a waste of time buying an index fund. Who's going to listen to that? I wouldn't have. I definitely wouldn't have. When people tried to give me this sober advice when I was just starting out, I said, what are you talking about? I'm smart. I can beat the market.
So you think people just need to go through that process of trial and error? Some will beat it, some will not, and they'll figure it out along the way or see where their bands of risk tolerance are.
Yeah, and I'm speaking in generalities. Certainly, some people will go off the deep end and get addicted and do things that are unfortunate. But I think that a lot of people will try the game, play the game and lose eventually, and say, oh, okay, you know what? This is probably not a great use of my time, and maybe do something else. Or or there are people who will contribute to their retirement accounts in a more prudent, what I would define as a prudent manner, where they have the asset allocation. I don't care of the vehicles, whether it's index or active or whatever. That's not a fight that I choose to fight. It's as long as you're in the market and you're allocated, you're going to be fine. And then maybe they love to do Robinhood as a hobby. Like they like to invest, gamble, trade as a hobby. I do that. I pick stocks because, well, I love to do it. It's great for content. It gives me personal satisfaction. It's a hobby. I enjoy doing it. Do I think that I'm going to beat the market? That's not what it's about for me. I do it because I love it.
How do you think about, one, the impact of social media making us potentially, particularly younger people, potentially more impatient? They now take information in short form, Instagram, TikTok, Twitter, etc., or X, overlaid with the fact that the markets have been gamified.
Young people grow up. And so, do I wish that the current environment did not exist as it is? Yeah. Am I thrilled with like the TikTok meme accounts and all of the crazy nonsense? No, I'm not. I think that people are smart. And I think that most people are able to see eventually. And you can make the argument, I don't know that I necessarily would, maybe I'm reaching for straws here. You can make the argument that the sooner people get this out of their system, ultimately, the better off they're going to be over the long term.
It's an interesting point. And that leads me to, will a lot of these people who you say, in your words, grow up? Does growing up in the context of wealth management and financial advisory mean that as they get older, they will start to want to work with advisors and have someone else manage their money?
Yeah, I think so. I think that there was a lot of talk in the 2010 era about robo advisors replacing human advisors. And at the time, I was more worried about it than Josh was, frankly. And Josh said, listen, this is TurboTax. People with money want to work with human advisors. And he was 100% right. He had a lot more experience at the time working with people than I did. But listen, I am not one of these people that rams financial advisors down your throat. There are plenty of people who are fully capable of doing it themselves. I think probably a lot of those people are overconfident that they can, but fine. But for people that want advice, whether it's for a specific reason, a behavioral reason, hey, listen, it's too much money, it's too much responsibility reason, I think that people will forever trust people with advice.
On that point, we talked a little bit about public markets and people trying it on their own, talked about people working with advisors or trusting people who provide advice. How much do you think investing in public markets helps inform people about how to think about private markets?
Certainly they're related because these are equities. If we're talking about stocks, these are companies. So some of the stocks you see on the screen every day, the prices, and others that you don't. And I'm not breaking any ground here to say that the private market takes its cues from public markets, probably on a lag. This is your lane, not mine. I guess a disclaimer. Before we go into the private conversation, I am not an expert. These are my views. I don't speak for the entire industry at all.
How much does an understanding of public markets and spending time in public markets inform views on private markets?
They're very different. Even though a business, private markets are in ways more complicated, more intimidating, more paperwork. Advisors do not understand private markets really at all. It's not what we're trained on. Our training is to give advice and to get a client to their end destination. This is one of the biggest transitions in the wealth management world. Is it used to be a product oriented business. We sell a product. The product could be a closed-end fund, it could be a private REIT, it could be whatever, and it was a commission business. And that has gradually shifted to the point where we are today, where this is a holistic advice business. And advisors are in the business of making sure that their clients are able to do what they want to do. And do they need private investments in order to hit their financial goals? Or do advisors need private investments to sell to their clients to prove that they have access and exclusivity and something special?
Talk to me a little bit more about that. Is this whole active passive debate in public markets and where advisors add value, is that in your mind, from an advisor's perspective, part of the thing that's driving advisors to say, hey, we need to do private investments and find a way to add value to our clients beyond just saying, hey, just invest in index funds?
Well, so that's a really interesting question, because who's saying, hey, we need to invest in privates for our clients? I know that there are a lot of people saying that. I know that there are articles being written about that. And again, I'm not speaking for the entire industry. And I'm not here to bash on private investments at all. But I am very curious, genuinely curious. The logic goes that individual investors want more access to private investments, and they want better technology, less annoying paperwork in order to facilitate that. That is the bet that's being made by a lot of people in the private markets. Simultaneously, we know that there's a business consideration here, which is that institutional investors, foundations, endowments, pension funds, whatever, they're already pretty well allocated to privates, whether it's 30% on average or whatever the number is. And individual investors round down to 0% on average. And so if you could just get individual investors from 0 to 2%, that could unlock trillions of dollars, right? That's the bet that's being made. And I don't have a strong feeling that that's not going to come to fruition, but I'm genuinely curious to see if it does.
Based on what you're saying, does that make you skeptical of the alternative asset managers who are creating products for the wealth channel and are saying, hey, wealth channel, you should invest in private markets, and here's some ways to do that?
Well, not necessarily. And I think the proof is in the pudding. If you look at the flows into Seaweed as an example, or BCredit, or any of the giants, there's a lot of money going there. So the demand is coming from somewhere. I guess the question that I would have is there too much building for not enough demand? I don't know. I really don't know, because I got an email the other day, and this is an anecdote, from an advisor who was saying that his clients won't stop asking about private credit. And I don't know if that's because they're seeing the articles with the yield involved. I don't know.
It's an interesting question, both in terms of why privates. I think this actually gets back to something you said earlier, is what is the intention behind investing? What is the goal? What is the end goal? Is it retirement? And I think certain people in private markets, Apollo CEO Mark Rowan comes out and talks a lot about how retirement is what they are helping people save for and invest for. Others would probably say the same. So it's interesting in that context. And then I guess that gets to some other trends. And this is where private and publics probably kind of come together in a sense, where it's, you think about concentration of public market stocks overlaid with the fact that private companies are staying private longer. I think in the US, 87% of companies with 100 million in revenue or more are private companies. So does that make you think that investors are missing out on a large portion of the market and growth by not having exposure to privates?
Yeah, so that's the really good point. There is tension between people in public markets and people in private markets. And the tension is that one of the marketed advantages to private investments is that the investments don't have to get marked as frequently, certainly not daily, like publicly traded vehicles do. And if I were a manager of publicly traded stocks, I'd feel pretty annoyed as well. However, I think that there is demand from clients, like almost like, lie to me. Like, it's fine. Don't tell me the truth. I don't want to see my investments marked every single day. And in a crisis, I don't want to be a forced seller. So to me, that's a big part of the value add of private investments, is that if you want your money because you're afraid, sorry, it's illiquid. We can't give it back to you. Now, where it maybe runs into trouble or goes too far is if the managers are literally lying. So if it's sort of like a wink, wink, nudge, nudge, where we all understand what's going on here, but when they start lying about Sharpe ratios and that sort of stuff, that's the stuff that I think everybody's like, well, that's just dirty. Just call it what it is. These are equities or credit, and just because they're not liquid and traded daily doesn't mean the prices don't fluctuate. So it used to be the illiquidity premium. What if it's the illiquidity discount? I'm willing to actually literally pay for that. And we've seen this over time. What multiple did they used to pay in the 90s for a company that they were taking over? 5 times? What is it, 15 times now? And I'm making it up, but it's directionally right. And so the problem is, how much leakage would an investor be willing to pay for the illiquidity discount that I'm calling it? So if the S&P is getting 9, would I say, you know what? Give me 7.5, just don't show me the daily returns. Is that where we end up going? The returns can't continue the way that they have, just based on a lot of the alpha was in the price that they were paying, and the prices are a lot different. So am I wrong there?
I would say components, yes, components, no. So I think certainly anytime more capital flows into a market, it's harder to generate returns just from market inefficiencies, as you well know. So I think that's certainly going forward a concern. Will private markets, particularly certain corners of it, venture has raised significant amount of capital. Private equity has raised significant amount of capital as well. And you see it in some of the numbers, the interquartile spreads between first and fourth quartile managers in big buyouts versus lower middle market private equity is very different. It's a much tighter spread in big buyout where much more capital versus lower middle quartile managers in big buyouts versus lower middle market private equity is very different. It's a much tighter spread in big buyout where much more capital versus lower middle market.
And that's what you would expect to
exactly.
see.
So I think not terribly dissimilar from the evolution in public markets over time, I would imagine, as that market has matured and as private markets will mature as well. I think what people in private markets would argue is that there's still such a big market to go after. Take credit as an example. So, and again, some may debate this, but Apollo looks at the private credit universe as Mark Rowan's been quoted saying it's anything on a bank balance sheet. So in their view, that's a $40 trillion market, not the $2+ trillion market that private credit's in. Now, we could certainly get into a whole conversation about issues, challenges with private credit as that market grows. Also, as rates continue to go higher, what that does for private credit. If there's more capital in this space, does that loosen underwriting standards? Does that cause potential defaults down the road? Or what happens if rates go lower? So I think there's certainly merit to going forward what do returns start to look like as more and more people get into private markets. But I think people would also say, when you think about the size of private markets, 14, 15 trillion or so relative to other markets, it's still much smaller on a relative basis. So therefore, there's still probably room to run. And also, the question then becomes, and again, you have people on all sides of this too, because the reality is it's net of fees returns. And I'd imagine that's, as a practitioner, that's what you care about most. It's net of fee returns. It doesn't matter if it's index fund, actively managed fund, private equity fund. Net of fees is what matters to you and your clients. So that, I think, is really the most important thing. Jenny Johnson actually said that. She said that on my podcast with Franklin Templeton. And I think that's a really good point, because at the end of the day, that's what you're trying to solve for. I have to imagine that's what you really care about.
Yes. And so let me bring this back to an area that I do know a little bit about, and that's how advisors think about these things. Advisors, as I mentioned, and again, I'm generalizing all over the place here, okay? So advisors in general don't know a lot about private markets. Dude, there are a lot of advisors that don't know a lot about public markets, because the practice of giving advice is almost a separate thing from the stock market, which might sound crazy to some of your listeners, but it's true. And so what an advisor is never going to do is put themselves in a position of potentially embarrassing themselves and showing cracks in the armor and not being able to confidently explain a question that a client has. Because if a client has 1, 2, God forbid, 3 questions about a private investment vehicle, there's a good chance that an advisor who generalizes won't be able to answer them. That's number one. Number two, they're certainly not going to want to potentially answer for what happens if something goes wrong with this 3% of my portfolio. So it's like, wait a minute, just what's the upside? I'm going to have to potentially answer for this thing that I don't even really understand for such a small percentage of their portfolio. So that's the traditional RIA person who is really giving holistic advice. Now, the world is a big place. And I understand that we're all incentivized by incentives. Allow myself to introduce myself. And so people will do what they have to do in order to generate business. And for a large portion of the universe, listen, this is a sales business, straight up, period. This is a sales business. And so there has been, and always will be a large appetite for uncorrelated assets, for alpha, for stories, for unique access. Like that opportunity is forever.
So I think you're bringing up a few really interesting points. I want to ask you about one of them, which is what should alternative asset managers do in order to effectively educate the wealth channel on the merits of private markets? Sure, they don't have to choose to work with alternative asset managers or pick private markets products, but what do you think they can do to combat some of the challenges that you referenced around if 3% of the portfolio doesn't work out, then advisors have to answer to that, or they may not want to spend their time thinking about it, knowing about it necessarily?
Well, Mike, I think I might have been talking to you actually. I was talking to somebody and I was like, dude, I don't even know what you're talking about. And it was maybe some acronyms and some jargon and some language. I was like, I don't know what you're talking about because this is not what I spend my time doing. And so I think the challenge is absent just a wave of demand. And listen, we're capitalists here. We manage almost $5 billion and we don't do much in private investments. And if there really was, and again, I'm not suggesting that our clients are representative of the entire universe here, but if the demand existed such that we needed to supply them with these investments, we would have done so by now. And so that's the part of it that I'm just like, is the demand going to meet the supply that's coming?
What's the reason as to why you haven't done privates? Is it more client driven, or is it that you philosophically believe that public markets make more sense for the majority of the clients that you have in terms of how you construct their portfolios?
The answer is I don't think we have an edge. And I take my responsibility for managing these people's financial lives very seriously. And I'm not really interested in dabbling. I'm not really interested in being the $47 billion into one of these gigantic funds that'll probably do fine. And then those are the big ones. Obviously, there's other issues. So is it like a no forever? No, it's definitely not. We're having conversations, but I'm more interested in differentiated solutions where I think we can actually generate returns well north of the fees that the managers take. And listen, I don't think that we have the access. That's all. So it's just a lack of expertise is really the big thing.
What are those differentiated solutions that you mentioned?
For example, having a network of people that are doing something different that I think our clients would be excited about, that I think our advisors would be excited about, that we could easily understand. Hey, this company is buying this business. They're using some leverage. This is what the business is doing. These are the investors. These are the terms, et cetera, et cetera. I think something like that would be more exciting than, like I said, being in one of like the gigantic funds.
Interesting. So it comes down to, if I'm hearing you correctly, more around customization, differentiation as to why you do something in private markets.
Yep.
That feels like that's part of the next wave for alts is access has been granted and the infrastructure has been built. Now, customization, differentiation needs to be figured out. And I think you just alluded to that.
Here's one of the potential problems that you can run into is how many different investments are you going to pitch to your clients? Because if we're just doing this a la carte, what if a client says, nah, I don't like this one, but think of me for the next one. And then you go back to them and you say, nah, I don't like this one, think of me for the next one. Well, you're probably not going to go back to that client a third time, but it's like embarrassing at that point. And also just the implementation of these investments, the K1s, all of the difficulties is something that I know that there's solutions coming to the marketplace, but it's a lot. And again, how much are you going to invest in these for these people? You know what I mean? Like, is it enough to overcome the obstacles, the mental hurdles, the potential downside? Is it going to change anybody's life?
Yeah, you're referencing some interesting points there. One of which the CEO of Blue Owl's global wealth business, Sean Connor, said on a recent podcast, which was that anyone who is trying to work with advisors on alternatives products, they're working for a fraction of a fraction of a fraction of their time.
Right.
How should the private market space think about that? Because that's a reality, and I don't think that reality is going away. You referenced how you help clients and work with them in all phases of their financial lives. You also have to run your own business. Alts are just a piece of that. How should alternative asset managers think about that aspect of things?
Well, that's a great question. So, who are they selling to? It's not just a matter of convincing the owner of an RIA, hey, you should take a look at this. Okay, fine, let's do that. Let's take a look at it. Then you have to get past the investor committee. Okay, fine, let's say that you do that. Then the investment committee has to be able to translate that into English to the advisors, or they'll have somebody from one of the relationship managers step in. And then you have to convince the advisors to convince their clients. And I think that's one of the big disconnects from people in the alts world who don't know what it's like to work with RIAs. I can't just be like, all right, here's what we're doing. 7% to this private credit, 3% to infrastructure, 4% to private equity. Here's our alts fund. Here's the RWM alts portfolio. It just doesn't work like that. And so getting away from the a la carte is tough. Building portfolios where this is our alt sleeve. I think there's a future in that. But then that becomes sort of difficult to manage because, as you know better than I do, like all the different vintages and timing of these things. And then, another area that I didn't even mention at all is operationally. Our ops people have never done this before. So now we have to get them up to speed and train them on workflows and all that sort of thing. And integrating that into our sales process and workflows, it's just a lot. And when you're talking about a small piece of the potential pie, it has to be so overwhelmingly obvious. It has to be so compelling. And there are solutions out there that are trying to solve for this. I don't have a strong feeling on where this goes. I'm not good at seeing around corners. I don't know, but I am curious. I keep coming back to that. I'm genuinely curious.
It's a really interesting thought exercise, right? Because what you're laying out are the real day-to-day questions and challenges that advisors face when it comes to deciding whether or not to invest in alts. And these are very real and valid questions and concerns. The question then becomes, what does it take to get you to the point where it's, okay, this is worth it?
We haven't gotten there yet. So I don't know that I have a great answer, but it would be comfort that this is not going to be a gigantic pain in the ass and that it's going to actually deliver value for our clients.
If there was one thing that maybe distilling it down too much, but if there was one thing that would make it easier for you to invest into private markets, what would it be that is either yet to be created in the industry or is not yet refined enough for you to be able to use it?
I don't know that it's one thing. These conversations that we're having, there's layers. There's a lot of different factors. And I think that the industry is pushing forward. There are new players coming to the market. And when I say I'm curious, I would love to fast forward 5 years and see if advisors are getting off zero, which of these companies make it. The alternative asset managers, this is their life. They eat, sleep, and breathe their investments. And the advisors are focused on something different. So how do we bridge the gap?
Yeah, it's a really interesting question because, like, you obviously have certain people who have philosophical views. Like, private markets are where you generate alpha relative to public markets. There are some people who just believe that. And some data has shown that to be the case. There are other people who would argue the other side of the coin, and they have data to support their side of the case. How much of this, in your mind, is a philosophical challenge?
Yeah, there are certainly zealots all over the world. I think that the world is not black or white. There's a whole lot of gray here. And is there alpha to be had in certain private vehicles? Of course there is. Of course there is. The challenge is, how do I find that? And how do I get comfortable knowing that the manager that I select, the direct investment that I select, how do I get comfortable that that's the right one? And again, I go back to incentives. The risks seem sort of asymmetric. So I give somebody with money a little bit of alpha, cool. But what if it blows up? Or what if there's a rush for the exits and they can't get liquidity?
How much of this comes down to education then?
It's a big piece of it. There are certainly a cohort of end investors that want this. And so I guess what I would say for somebody in the alternative manager space who's listening, thinking about how we access RAs, I would say we're the prettiest girl at the ball right now. The questions that you're asking are the questions that everybody's asking. And I would say one way to differentiate yourself, it's about the people and the processes. Let's just stipulate that the product is good. It has to be good. But this is a relationship business. Life is a relationship business. Certainly financial advice is, wealth management is. People do business with people they like. And you have to feel that the person that you're working with, a relationship manager, is doing everything they can to make you look good in front of your client, to provide value, to hold your hand, educational material, making the process streamlined, and all of those things. And so the companies that are able to do that really well are going to be the companies that win.
It's a really interesting point that you make. And where my mind goes is to the ETF and mutual fund world. What do you think are some of the lessons learned that you saw in those two worlds that can be ported over to the alts world in terms of how to actually effectively work with the wealth channel? Because those were two products that were innovative at the time, had to go through education. But then at the end of the day, to your point, relationships and people and trust.
That's such a great point. ETFs certainly did not explode onto the scene in 1993 when the SPY started trading. It took a decade or more for them to gain acceptance and popularity. And in terms of the rocket ship that they're on now, that only happened in the last decade or so. I think some of the lessons are these things are sold, not bought. So you need really talented salespeople, relationship managers. I just keep coming back to the people. It's one of the most important things. I know it's cliche, but it is for a reason. And the other thing is timing. There's a graveyard of ETFs that were too early. And then there's other ETFs that had spectacular success because they launched at a time where the market winds were at their back and what they were bringing to the market was in favor. And that part of it, unfortunately, you can't really do much about that.
Sounds like Bitcoin ETF might be a good example of that one in a sense.
That's one of them.
Yeah, it's really interesting to think about how right now private markets are in a world where the products are sold, not bought. I think you're absolutely right on that. And it sounds like that will continue for a while. Do you think we'll ever get to a point where the product is bought, not sold?
Maybe. Here's where that could happen. We haven't even spoken markets yet. So one of the reasons why perhaps we've been hesitant, and we've been hesitant really since the beginning for reasons that I mentioned earlier, but one of the reasons why people have been very comfortable with public markets is because they've done amazing. So this is not rocket science. We're doing what's working. If there's a world in which the market goes sideways or heaven forbid has a lost decade, which has happened before, will happen again, and there are areas of the private market that shine, whether it's hedge fund like strategies, managed futures, whatever, or I was about to say private credit. It's hard to see private credit holding up if there's a really, really long bear market recession. But if there are things that start to work or that work over a period of time when public markets start to falter, then yes, these things will be bought, not sold, because we know that investors always are fighting the last war. And so that would be an environment, and I don't know what would cause that, but that would be an environment where people start asking for these things.
Interesting. You mentioned public markets. I want to go there because I think that does, like you said earlier, it's certainly related to private markets, and what happens there going forward is going to have a big impact. What do you make of this year's markets?
In 2023, the only thing the market cared about was the direction of inflation and what that meant for the bond market, specifically Fed funds futures. We made a chart showing that in 2023, the S&P 500 tracked the implied Fed funds future rate very, very closely. And so if you were to invert the Fed funds future rate, so basically what the market was implying the Fed funds rate to be, if it was going higher, the market would sell off. And when it went lower, the market would go up. And that line tracked really, really well until the year rolled over and 2024 started. And the Fed fund futures implied probability of rates kept going higher, but the market kept going higher. And so the relationship completely diverged. And so why is that happening? Whenever we talk about the market and why is something doing what it's doing, my answer is always it's never one thing. The market is a super complicated place. But I think that the market has shifted its focus less on rate cuts and when they're going to happen and more towards fundamentals and earnings and the strength of the economy. Now, that relationship has since changed since we started recording. It's Wednesday, April 17th. The market is responding. And again, maybe this is just narrative fallacy. The market is selling off as rates have continued to go higher, as the narrative of higher for longer really starts to take hold.
So today, April 17th, this moment in time, does this make you want to take more risk or less then?
That's a good question. So I don't invest on that way, but I'm a human being and I certainly think in those terms. The natural intuition to all-time highs, and you alluded to this earlier in the show, is your antennas go up. Like, this is as good as it's going to get. Market's going to roll over. I'm going to get rugged. And the market generally doesn't work like that. It's very rare for the market to just free fall from an all-time high. There has to be a catalyst or exogenous event, like COVID actually is a great example of that. Usually, markets start to sell off and then they crash. Usually, you have time to get out. There's usually a warning. We looked at the data, and 1, 3, 5 years later, investing at an all-time high, I don't know what I was expecting the data to say, but what we found was that you are no worse off. In fact, you're a little bit better off investing at an all-time high. And that's because markets aren't at all-time highs for no reason. And why is this market all-time high? Well, I don't know. Because earnings are at an all-time high, perhaps. Because cash flow is at an all-time high. Because the Fed is probably going to cut rates. It's not make-believe. The market is at an all-time high. The price of these businesses are at an all-time high because the earnings of these businesses are at an all-time high. That's it. It's not that complicated.
Brings up an interesting point, and maybe I take this more from like the venture perspective, where we often underestimate how big market size and therefore the potential revenue opportunity and earnings can be of companies in the long run. But in the short run, who knows, right? How much do you think people should take that perspective when thinking about it? Sure, if they're playing in public markets, you have to think more about near-term risk in certain cases. Maybe you do want to sell at certain points rather than just buy and hold. And maybe that's my mindset because I'm more of a venture investor than a public markets investor. But how do you reconcile that concept and framework of over the long run, things may in fact be bigger than we think they are? I think you even referenced this in one of your blog posts recently about don't worry about Amazon going down or this or that. In 20 years, it's much bigger than we thought it would ever be.
So I'm always worried. Even though I'm an optimist, I always think the market's going to sell off. That's just my human biases. I think we all have some of that. And so if we're investing for a purpose, and the purpose is financial security and to put our future selves in a position of success, and especially if this is literally a retirement account that I can't touch for 20 years, what do I care what the market does today? And in fact, if I'm contributing to my retirement account, which I am, selfishly, I want the market to crash so I could buy lower. Now, I don't actually want that because that's not good for anyone. The market crashes when people lose their jobs. I definitely don't want that, so I don't want that out there. But I want to invest at lower prices. That would benefit myself and current savers. And so that's the answer for those people. Now, if you're in retirement and you don't have any more money coming in, well, then that's a completely different conversation. And I got back to this earlier. How much money can you invest in risk assets such that you can go along for the ride and not feel FOMO in a bull market? And then also have the balance of if things go south or sideways, that you could stay with it. Because what I think doesn't work, what I know doesn't work actually, let's be very clear here. What I know doesn't work is emotional investing. Oh, I'm scared now. I'm going to sell because the market just fell 15%. Oh, the market now is up 40%. Shit, I better get back in. I know for a fact that doesn't work. So if you were to say to me, if you were a client and you said, hey, listen, we're 70-30. I hear what you're saying. I get the data, but I'm nervous. And I understand, but I'm nervous and I want to downshift. Fine. If you want to go from 70-30 risk assets to treasuries or whatever your risk off bucket is, money market funds, whatever. If you want to go from 70-30 downshift to 60-40, fine. You're going to be fine either way. But if you go from 70-30 down to 2080, that's the type of all in, all out big decisions that you can't come back from that, because the easiest thing in the world is to sell. Ah, I feel better now. Yeah, I lost money, but at least I can't lose any more money. That's the easiest thing in the world. When the hell do you buy back?
So that brings up a really interesting point around psychology, also around thinking about things over longer periods of time. You recently talked about this decade being similar to the Roaring 20s, which would mean kind of continue to go up. Obviously, there were challenges after the Roaring 20s in a number of ways. How does that framework and thought align with what you just said and how people should navigate that short-termism, short-term investing psychology?
So I'm not a historian, and it was my colleague Ben Carlson who said the Roaring Twenties, not me. But I think what he was alluding to was this could just be a wonderful decade of prosperity, which certainly doesn't jive with the general mood of the population. AI certainly will be a big part of that in terms of productivity gains and what it might do to GDP. Estimates are for 1.5%. Who the hell knows? But in terms of avoiding the short-termism, listen, I wrote a blog post in 2015, literally 9 years ago, talking about how investors should prepare for lower returns. And the reason why I wrote that was the markets, I'm using air quotes here again, felt very stretched. And if you looked at traditional valuation metrics, guess what? They were. But here's the thing that I couldn't foresee in 2015, and I don't think anybody else foresaw this either, was the runway that these mega cap tech stocks had in front of them to continue to compound not just their share price, which is a reflection of their businesses, but their bottom line and their top line at just ludicrous rates, unprecedented, at margins. We've never seen this before. And so that's why I am humble in the face of the market to say, I have no idea what's going to happen. Not a clue. But I do know that investors need to prepare for a wide range of outcomes. If you can do that and you can get to a place where you're comfortable and you don't have to fidget every 2 seconds, you got to put yourself in a position of, listen, this is the risk that I'm taking, and let the chips fall where they may, and worry about things that you can actually control.
You used a worry in that last sentence that I want to hinge on. What's your biggest worry about the current market?
I would say two things. Number one, and this is not so much of a concern because I do believe that this is a secular story. If the market loses its leadership, so it already lost Apple, it already lost Tesla. If we lose Nvidia, and if we lose Google and Amazon, we're going to have a correction. Fine. Does that worry me? No. I think bear markets are part of investing. So does that keep me up at night? No. In fact, nothing keeps me up at night. This is a Bill Miller quote. The market spends a lot of time worrying. I don't have to do that. We always fear the worst case scenario. The market is always discounting bad news. We climb the wall of worry. That's what we do. The other, I guess, worry about this particular market is that the economy is too strong and that rate cuts just keep getting pushed back and interest rates go higher. And it's not just competition for risk assets, but it's actually affecting the cost of capital and like Main Street, not Wall Street. Here's one last very unsatisfying answer. Whatever people are talking about as their worry, somebody might throw out commercial real estate. If we're talking about it, that's not what does it. It's always what you don't see coming. Risk is what you're not worried about.
That's an interesting segue into something else I want to cover, which is content. You've been a pioneer of content creation and maybe being able to both share things on your mind as well as think about other things. Maybe that actually gets to some of the heart of the last question, which is it might help you uncover whether you're actively thinking about it or just piecing together the dots of, oh, maybe this is something that's going to happen, or I should be worried about this because I'm connecting the dots and seeing what's happening. How do you think content creation has helped you in your business?
Yeah, so thank you for the kind words. I don't view myself as a pioneer. I think I'm certainly following others who have blazed the trail before me, but content has been everything for us. I mentioned that people do business with people they like, and certainly not everyone likes us. But I think for the people that come to us, they're familiar with us. We've written thousands of articles. I've done a million podcasts. It's not a mystery to know what I think about the world, generally speaking. So it's been hugely helpful for us in terms of distribution, customer acquisition, all that sort of thing. There's another angle of content that I think is underappreciated, which is that it allows us to broadcast to our clients when things do get a little bit hairy. And that makes our advisor's job a lot easier. We're able to talk to all of our clients at once without them having to sit on the phone one at a time, which certainly was always part of the job. But just in terms of getting our message out and talking to our clients, it's been hugely helpful.
On those points, what do you think wealth management firms and alternative asset managers who are now engaging with the wealth channel, trying to get out there more as well themselves, what can they learn from your experience with content?
Yeah, it's hard because there's so much content in the world. When people choose to listen to Animal Spirits or the Compound and Friends, they're choosing to listen to that instead of, or in addition to Joe Rogan or Bill Simmons or whoever. And so it's not like asset manager X is going to compete for somebody's attention with asset manager Y. They're competing with Bill Simmons. And so you have to make it entertaining. And that's really difficult. It has to be, of course, informational, but it has to be fun. And brands aren't fun. So I don't know that I have a great answer for them. It's hard. It's hard.
Well, you're hitting on a really interesting point. Something I think about a lot too is like, how do you actually stand out? Because content creation and content generation is becoming much more saturated.
Yeah, and then there's compliance. I don't know how much fun these people are allowed to have. And this is a serious business. And so I don't know that you want your alts manager cracking jokes either. So I don't know the best way for content dissemination. I would say doing shows like this, like talking to you, talking to us, being more human and telling the story and be an ambassador for your brand, and then let the relationship managers come in and really do the work that needs to be done.
I think that's great advice. And I think that's something we've seen. I mean, I wrote about this a little bit, the Blackstone and Apollo holiday videos. They were trying to humanize private markets. Blackstone did the video to the Taylor Swift Eras tour theme. And I think that kind of thing was fascinating. Everybody made fun of it, but in some ways I thought it was brilliant because they're humanizing themselves and making themselves seem more accessible. And the things they do, they showed a picture of Bumble, they showed a picture of a shipping containers and a cargo ship. Those are real world things. They happen to own those businesses too.
That just triggered a response from me that I can't even believe I didn't mention earlier. But when we're talking to clients, and I say I, the advisor, is talking to clients, we know what Apple does. We know Apple's our second biggest position or whatever, and Microsoft our first or wherever the S&P is today. We're all very familiar with these companies. When you're investing in private equity, it's like, well, I don't know these names. So that's just an additional challenge that we didn't mention earlier.
Really good point, though, because there's a remedy to that challenge, which is talk about the types of things you're investing in and show what they are. Because the reality is people are probably using them in one way, shape, or form.
Yeah, and you know this better than I do, but how many tens of millions, is it 100 million people does private equity backed companies employ in the United States?
So I think that's a fantastic point. I think that's the incredible thing of what you've done with content is you're able to humanize what you're doing and also talk to people all the time. I think other people have probably taken a cue from you because in the wealth management world, because they've seen how powerful that can be. I guess on that point, you were early to the content creation world within wealth management. I know you say you're not great at seeing around corners. I would probably argue with that point, but what is the next big thing then? If content creation was the thing for wealth management, is there the next big thing after content creation?
One of the areas that I'm excited about is what AI is going to do to our productivity. I think that there are companies building right now tools to make the day-to-day job of an advisor way more productive, effectively eliminating the power planner role
Mm-hmm.
via technology, help me get ready for meetings, all sorts of stuff that technology, there's no doubt that's coming.
Does that mean, from a business of wealth management perspective, does that mean you think there could be less advisors or advisors' time is spent doing other higher value things?
Both. I think that advisors are going to be able to work with more families. It's different for everyone depending on how much complexity you're dealing with, the level of wealth and all that sort of stuff. But let's just say that an advisor caps out at 75 relationships, give or take. I think that AI is going to push the ceiling much higher.
From a business perspective, How do you think that changes the margins?
Well, hopefully it improves them because wealth management, we are not Meta in terms of what our margins look like. So we are fighting, scraping, and clawing for a better bottom line. We like the industry. And so I think like every other business, anything we can do to have more revenue fall from the top line to the bottom line, we're going to take that seriously.
I think that's a really good point in terms of what something like AI can do to an industry that's, in some respects, a services industry that's certainly being impacted in a positive way by technology in a number of senses, whether it's investing side, operational, client services, et cetera.
Yeah, I'll just give you a quick example. The REA industry, there's a structural shortage of client service associates. There's not a lot of turnover because it's not like they're an advisor where they're taking a book from Morgan to Merrill or whatever, and there's checks and bonuses and all that sort of stuff. Financially, it's generally a lateral move. And they would move if there's something bad at their current. So they're hard to find. So we saw a company that's making, we call them CSAs, client service associates, more efficient in terms of making it easier to open, onboard accounts, having like a repository for information such that if a client moves or their email changes, you don't need to update it at every single system. And there's systems all over the place. Don't even get me started on that. To have one central place where this is the hub, you update it here, it blasts everywhere. That was attractive. And that sort of thing is just going to continue to come and come and come.
I think that's a really fascinating point and really important when we think about wealth management, because I think the other piece of wealth management that's interesting is it's becoming more private equity backed. So the industry itself is evolving. So, or has become. It's right in the middle of that evolution. I want to move to a quick fire round to close things out. So ask you a quick question. You'll answer with a short one line or maybe even word. So what happens as we get closer to the elections?
Oh, God, I hope nothing. I hope nothing. I think whatever happens, the market will, I don't want to say breathe a sigh of relief. The market hates uncertainty. And if the market wobbles to the election, I think whoever gets elected, I think the market will say, okay, at least we know now and it'll look past it. I don't think the election is a market moving event.
Do you expect rate cuts to happen this year?
Yes.
How many?
Okay. So I was saying it before, it's cool for Powell to say it. I had been saying, why are we cutting? I don't understand why we're cutting. And this is before inflation turned back. I was like, if the economy is so strong, we're on the 1 yard line. Like, why spike the football prematurely, cut prematurely, and then see the housing market explode, stocks shoot higher, and then the inflation come back? Why would we do that? So I had been in that camp since the beginning of the year. I still do expect them to cut. And hopefully it's not an emergency rate cut where we have to cut because, oh shit, something broke. So I think that we're going to get a cut. I don't know what the number was at the beginning of the year. Was it 6 rate cuts? I think it's down to like 1 or 2 now. So maybe we get a cut, maybe we get 2, but I don't expect anything more than that.
What aspect of private markets excites you the most?
Private markets power the future growth of this country. Venture capital is doing that. And let's just look at what we've seen from the advancements in AI over the last, when did it start? Was it November 2022? Yeah. It's not barely even been a year and a half since the thing was even unveiled to the world. So I am excited that there are pools of capital that are willing to take risks, willing to bet on innovation, willing to fund ideas that seem crazy. I think that is one of the best things about this country. So I love the venture capital ecosystem.
I mean, that's a great segue into my final question I ask everyone. What is your favorite or most interesting alternative investment?
The Quarter app, QUARTR. And the reason why I'm so excited about that is because these guys came to me in 2021 with an idea about turning earnings calls effectively into podcasts. And Ben and I said, that's pretty cool. We'll give you a couple bucks. And we did. And that was 3 years ago. We've since given them actual money out of our fund. The investments and advancements that those guys have made are amazing. I am so proud of the team. I am a power user of the product. So that I would say is the one that I feel like, I don't know if kinship is the right word, but that's the one that I'm most excited about right now.
I love it. That seems like that provides a very important service to the financial services world, making transcripts easily understood, digestible, and actionable, sounds like, which is super important.
It's magic. It's magic. I love it.
That's another really cool thing about what you do is you're able to operationalize a lot of the things that you invest in because you can try them out at Ritholtz.
Yep.
Love it. Well, we've tied together public and private markets quite well here. So that was a great way to end. Michael, fantastic conversation. Thanks so much for coming on the Alt Goes Mainstream podcast.
Well, let me say to you, thank you. I love reading your Substack on your view of the industry. I learned so much from it. So I wanted to thank you for that. And thank you so much for having me on. This was a lot of fun.
No, I appreciate that. Like you said, education and understanding what's going on in the space is super important. So pleasure having you on the show. Thanks so much.
You got it.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going